Brian, before we look ahead to the second half of 2025, let's take a quick look back at the market in the first half. Stocks rose, big post-Liberation Day dip, and then a huge recovery. What are the lessons that we learned from that?
Well, Greg, maybe not a lesson, but a very stark reminder. And that reminder is there's no crystal ball. So you need to have your portfolio ready to take advantage of these dips when they happen. Now, remember, almost half of that 19, 20% drawdown that ended on April 8th actually happened before Liberation Day, the 6 weeks leading up to it. It was that pocket of time from Liberation Day to April 8th. We had 4 trading sessions where we really saw huge spikes in volatility and valuations really cratered across stocks and credit. The portfolio allocators that had cash to deploy into that weakness were the ones able to take advantage and able to be able to do that the next time around. You need to have a well-constructed portfolio, and you need to make sure your portfolio is well aligned with your client's risk tolerance, more importantly.
Okay, so now let's look ahead and talk about portfolio construction themes and trends like you've just been talking about for the second half. How should people be breaking down their portfolios?
I think we're going to see a combination of re-risking and de-risking in the back half of 2025. Those re-riskers are those clients that are still sitting on more cash than is probably needed for their investment portfolio. If you look at household deposits, money market fund AUM, we estimate that total cash on the sidelines as a percentage of total net worth today is nearly 7%. That's approaching GFC levels. So I think in the back half of the year, we're going to see a few Fed rate cuts, most likely. That's going to get people to start to realize, after taxes and inflation, I should probably get back into my investment portfolio. In terms of de-risking, I think a lot of clients have done extremely well over the last 5 to 10 years, and they're going to be looking for opportunities to de-risk from the public equity market into areas of the fixed income market that are more undervalued today, and also into income producing private markets that can generate more stable returns over the long run.
So what's the breakdown? If it's no longer a 60-40 portfolio, how much into the private markets? Is it 60 stocks, 20 bonds, and 20 private? How would you break it down heading into the rest of the year?
I would say it depends, but that's not a very interesting answer. We know from data that of the 35 to 40% of financial advisors that use private assets, private markets, they only typically allocate somewhere from 5 to 10%. So I would say for the due diligence you're doing in private markets to truly move the needle, perhaps it's more than 5 to 10%, but it's all going to depend on that financial plan, the client's liquidity needs for them to really unlock the opportunities in private markets.
Let's break it down a little bit further. In the first half of the year, we saw international stocks do very well. Do you think that's going to carry on in the second half? Or on the fixed income side, do you foresee high yield doing well, emerging market bonds? What are your thoughts digging down a little bit deeper into the asset classes?
Yeah, so the international US debate has been one that's really resurfaced this year. And to my point earlier, those advisors that stuck with their international allocations, they were able to rebalance into weakness and take advantage of those valuation opportunities in April. I think going forward, I think the burgeoning kind of sell the US trade might be a little bit overdone. I mean, we've seen the worst start to the dollar index in the last 40 years. We're still finding opportunities in US equities, but you have to be selective and focus on fundamentals because really quickly we've seen valuations come back up. On the fixed income side, it's a little bit of a similar story, Greg, where starting yields today across most fixed income sectors are elevated versus historic norms, but credit spreads, the compensation you're getting above the risk-free rate, has shrunk, has compressed. The one exception to that is the municipal market, which has lagged the taxable market by its greatest delta in the last 40 years of data or so, outside of maybe 2020. So there's a lot of opportunities for those high tax earners to take advantage of those elevated yields in the muni market. We have an elevated curve where you're getting paid handsomely, particularly after adjusting for taxes on the long end of the muni curve.
And then finally, the other buzzword of the first half has been uncertainty. So how does Nuveen's portfolio strategy group work with advisors to make sure that they are okay with all the uncertainty out there? Because although everyone's nervous, it really hasn't affected the S&P too much, which keeps hitting record highs.
That's true, but I do think advisors today realize they're almost getting a second chance, right? Because markets came back so quickly, as you pointed out. I started this segment talking about there's no crystal ball, and I'll end that way. Nuveen's portfolio strategy group, we're really here to partner with advisors to leverage the expertise across the Nuveen investment platform. So we're embedded in the investment organization. We have forward-looking portfolio analytics that we can run for clients to help them diagnose hidden pockets of risk and return in their portfolios and tweak things on the margin. And lastly, our portfolio construction tools cut across public and private. We think the next decade is going to be all about the kind of convergence of the public-private paradigm to build more resilient portfolios for clients. That's really what we're here to help advisors achieve.
All right. Well, thanks a lot for coming on and talking about it.
Thanks so much.